Intercompany transfer of services and non-current assets. In this learning objective, we're going to look at the downstream sale of a non-depreciable asset or land, and we're going to focus on the consolidation accounting. As I said earlier, we're going to focus on the EJEs of specific interest, which are the transfer of the land between the parent and the sub. We're not going to spend a lot of time on the entries that we've done since Chapter 2. And that includes the current year activity between the parent and the sub. You can see the information comes from the book value schedule, and here's the entry. We also have the NCI activity, which comes from the book value schedule. And then the last thing we see on a regular basis is the sub's equity, which comes from the book value schedule as well, and gives us the following entry. Now let's address the item of interest, which is the special allocation of any unrealized gains or losses. And the first we'll address is the equity method entry that's out there. And remember, this is the entry we made during the year to record the deferred gain that occurred between the parent and the sub. We debited income from subsidiary and credited the investment account. So with that in mind, this is what our three-part worksheet looks like after EJE1 that eliminates the current year activity between the parent and the sub. Looks like we have a $45,000 debit there, which represents the unrealized gain on the land. So we need to eliminate that. So we're going to debit the investment account, credit income from sub, and this entry here undoes the effects of that earlier entry. So that leaves us with the last EJE of interest is the unrealized gain or loss, or the deferred gain or loss. And the three-part worksheet gives us a really clear picture of where we stand at this point. Included in the parent's net income or sub, the parent's income from sub, $27,000 was two amounts: the sub's net income and the deferred gain. And we've eliminated that with EJE 1 and 4. But in the process, the parent still has on their records a gain on sale of land of $45,000. So remember, we have to eliminate anything that remains between the parent and the sub. The $45,000 is there. We've got to get rid of that. And the sub has something that we need to address as well. The land on the sub's records is at $70,000, which is what they paid. But remember, that land is overstated because the original cost of the land by the parent was $25,000. So the land is overstated by $45,000 as well. So we've got to do two things with the next EJE. One is eliminate the gain on the land, and two, we need to restate the land at its correct value, which is $25,000. So we'll make the following entry. We'll debit gain on sale of land and credit land for $45,000. The EJs will look like this. And here we see we get a really clear picture on our partial three-part worksheet, in that we see that one, we've eliminated the deferred gain. Two, we've restated the land to its correct value of $25,000, and obviously you can see that we've eliminated all the activity on the income sub. We can compute our consolidated net income, and from this we know that the $45,000 gain is included in the consolidated net income. The parent's operating income, and we can reduce that. So what we need to do is really our starting point for the consolidated net income is going to be the 197, or the number net of the gain. We see the sub's net income. We're going to allocate out 20% to the NCI, and we get the controlling interest value there of $269.